just a little bit about the purpose of property versus trading webinar. Property versus trading purpose is to introduce you to two asset classes of diversification to minimize your risk and increase your returns. For traders, it is to know one additional asset class that they can put their money to work further, and for property investors to learn an additional passive cash flow stream that they can possibly reinvest back into properties. Today's speaker that we're going to interview today is Simon Zutshi. Simon Zutshi is a financially independent professional property investor. He has over 2 decades of personal experience investing in residential property in the UK and overseas. Simon started investing as a first-time buyer in 1995. As a recent graduate in debt, he found a strategy to purchase his first property using none of his own money. By the age of 32, he was financially independent, all from passive income generated from his property portfolio. Simon, it's a great pleasure to have you today on Property versus Trading.
Thank you very much, Thiru. Really pleased to be here. Thank you so much for inviting me.
Thank you. So let us just know a little bit about you before we get into the detailed stuff for today's lineup of questions. So just tell a little bit about you, like how did you get into this world of property? How old were you when you started? What event triggered your interest? And do you do other things as well along with property?
Yeah, so I started in 1995. I was 24 at the time, and I was just starting work at Cadbury's in Birmingham as a graduate trainee. And as soon as I got a job offer, I bought a house, and I bought one a little bit bigger than I needed. And I rented out 2 of the rooms to my friends who were still at university, because we lived in Selly, just next to Birmingham University, just down the road from Cadbury's. And it worked really well. And I kind of covered the cost of my mortgage and pretty much my bills. So I was kind of living for free. So I was working full time in a graduate job, bought this property just for something to live, really. And I actually did have a part-time business that I was running at the time as well, which was running student nightclub events, which is a great fun business to do at that time. And that's actually how I was able to build up the deposit to buy my second property, which was in 1998. And the reason I did that was because I wanted to move a bit closer to Cadbury's, kind of out of the student area. And instead of selling my first house, which is what most will do, to buy the next house, to sell one, to get deposit to buy the next one, because I was saving a lot of my salary, because I wasn't spending money on my mortgage, because my tenants were covering that, and because I had money in my business account for my part-time business, I had enough deposit to buy a second property. And really it was in 1998 when I moved out of my first house into the second, and I rented the first house out. That's when I had this real light bulb moment that actually property investing, you can work once and get paid forever. Because I had this money drop into my account, and after paying the rent, so the mortgage and the insurance and the maintenance stuff, there was some money left over, some profit. And the same thing happened the next month and the next month, and it's paid me every single month for as long as I've owned that property. And I went on to buy a lot more properties, but this is the great concept that I really want people to understand when it comes to property investing. You can work once and get paid forever. And it took me a couple of years. I started to buy more, and by 2001, I had enough coming in, not to replace my income, but to cover my living expenses. So I actually left my full-time job. And that was a big decision. You know, I'd always wanted to work for a big company like Cadbury's, great company, great people, great product. But I didn't like getting up in the morning early. Ironically, I now get up quite early because I want to rather than because I have to. And also, I didn't like the fact that I couldn't go on holiday when I wanted to go on holiday. I only got a certain amount of holiday a year. So that's ultimately why I left. And it took me a couple more years. By 2003, so 8 years after I'd started, I completely replaced my income that I was earning when I left Cadbury's from my rental profit. And that's a great position to be in, because it really frees up your time and you can spend your time doing whatever you want to do. So I still actively invest now, but I spend most of my time doing things like this, teaching other people how they can also be successful property investors.
Incredible, Simon. Very interesting background there. You know, just one little question I have on that is, you know, you said you started in 1995, you worked in Cadbury and you bought your house, but was there any particular event that actually triggered you to like buying a house, or rather than renting it? Was it a friend who told you, or was it your family, or what was it?
So none of my family, sometimes people are lucky because they've been brought up in a family where their parents have invested, or grandparents.
Yes.
That didn't happen for me. My dad was a GP, a doctor. It would come from Kent, and he was working hard doing that. So I didn't know anybody who was a property investor, none of my family and my friends. But when I was a student, I met my student landlord. And we went to his very nice, very large house in Edgbaston. And I kind of remember asking him, I said, excuse me, I hope you don't mind, what do you do for a living? Because it's a lovely house. And he said, well, I used to be a solicitor, but now I'm a full-time landlord. And to be honest, Thiru, I didn't really know exactly what that meant at the time, but I guess it planted a seed. And I later worked out that actually the rent we were paying him was probably a lot more than it was costing him to hold the house. And I guess I didn't want to rent. I saw that as throwing money away. And my family, we've always bought our own homes. My sisters had their own home, but no investments. And so it was kind of a natural progression for me to try and get a house to live in. And I didn't buy something just for me. I bought something that was big enough for a couple of friends to share as well. And I like living with other people. And I kind of, if I'm really honest, I kind of fell into it. It's only really in 98 when I got that distinction that I realized, hey, this is a really good thing and I should do more of this.
Interesting, isn't it? I think everybody that we interview, there's always a series of orchestration of events that leads you to where you are today. And for you, I think it was interesting to see that it was your landlord that actually inspired you to get onto the property ladder. I mean, wouldn't I say inspired, maybe probably put a seed in that germinated later on, you know?
Yeah,
it's interesting.
Yeah.
Okay, that's good. So going on into more detailed questions over here on trading versus property. So you see, Simon, in trading and as traders, you know, we have different types of traders. We have like position traders, swing traders, intraday scalpers, like really like short term, you know, taking money in and coming out. So similarly in property, I'm sure there are different types of investment, like flipping, buy and hold, for yield and capital appreciation, and so many more. So we would like to know, what is your main style of property investment?
Okay, so let me share with you. I've done not everything, but I've done a lot of different strategies. Just like trading, you can make money. In property, you've got to understand that the lead times are a lot longer than in trading, obviously. Trading, you can be in and out in a day. It's very difficult to do that in property. Okay, so property, you can buy something, you can add value to it, you can renovate it and then sell it on to someone else. And I've certainly done that before, and that's a shorter term thing. And a lot of people think that's how you make money in property, because they get paid a lump sum of cash. And I mean, a lot of people, particularly builders, who do that. The only problem with that, as far as I'm concerned, is that when you sell the property, but like when you sell your shares, you crystallize the profit, but you can never make any more money from those shares or that property. Whereas if you hold the property long term, then you get cash flow every single month. And at some point in the future, you might get a payout. Now, without getting too complicated, if you own property in your own name, it's always used to be the best way. It's not so much the best way now, but it used to be the best way to do it. You could own a property, you could buy it, you could add value to it. Then you could, based on a higher value, you can remortgage it. So one of the things I love about property, it's very difficult for you to buy stocks and you to influence the value of that company. However, you can buy a property and you can add value. You can increase the value to higher than the average value because of what you do to it. And with a higher value, you can then refinance it and often get all your money out. And the money, so you've got no money left in. It's a bit like, I guess, the concept, I've done this in the stock market. I've had shares that when they've doubled in value, I've sold half of them to get my initial money back. And then the other half has just been profit I've just let kind of roll. Does that make sense?
Yes,
so I guess that's the equivalent to buying and refinancing, taking out your money. So what you've got left over has none of your money invested. Admittedly, there's a mortgage on it, there's a debt. But the great thing about property, as long as you know what you're doing, is the tenants pay that for you. They pay you rent each month, which should be more than enough to cover the mortgage and the insurance and the maintenance and the management, and ideally still give you a profit left over. So the thing I love about holding property long term is that in the UK, we live on an island with a limited supply of accommodation and an increasing population. So what this means over the long term, property values and also rents go up because of supply and demand. We just don't have enough accommodation. Now, obviously, just like any market, like the stock market, it's cyclical. It doesn't always go up. It goes up and it goes down. And we had a big correction in 2009 because of 2008, 2009 because of the global credit crunch. I believe we're going to have a correction in the market right now because of what's happening in the economy. And also there's some other things that are affecting landlords that some of them want to start selling up because they're now taxed differently. I mentioned it was best to hold property in your own name. That's no longer the case. So some long-term landlords who might normally retire in the future, they're bringing that decision forward and looking to sell. So I think we're going to see a bit of a property market crash, dip, decline, whatever you want to call it. And that's why we are seeing initiatives by the governments. It was just announced today that there's a stamp duty holiday for people who are buying homes, first-time buyers. We still have to pay as investors, unfortunately, but I think it's up to £500,000. There's no stamp duty. So that's going to really help stimulate the market. And the reason the government are doing that, giving that tax money away, is because they know the property market is going to crash. The Bank of England said it's going to come down 16%. So actually, if you know what you're doing, it's a great time to be buying as long as you're holding long term.
Okay, good. So I think what I gather from that is that your main style of property investment is to buy and hold it for the long term using rental, right?
Yes,
rental
indeed.
yield. Yeah. Okay, great.
Yeah.
Okay, good. So that's good to know. In terms of entry, so let's go on to the entry type of questions. You see, for example, in trading, whenever we want to enter into a trade, let it be to hold it on for the long term, or let it be to exit within the day. When we want to enter a particular setup, we either look to enter the market either at a retracement when it's falling, and then we look to buy it like at a cheap price to capture a turning point.
Yes.
Or we wait a little bit. We wait for some momentum to come back into the market, or you may call it some buying pressure, so that we are not looking to catch a falling knife.
Yes.
So then, in terms of property investments, how do you guys do it? Is it more like value investing where you buy below market value, or are you looking at more on yield? Is that like a concept to all your investments that you take?
Absolutely, yeah. It's a combination of all of those, to be honest. You might have an area, and let's say the average value in that area for a 3-bed house is £200,000. And I know in some parts of the country it'll be a lot less, some will be a lot more. Let's say an average is 200,000. One of the things we do value investing. So we will look for sellers in that area that we want to invest in who may be happy to take less money than the true market value, because maybe the condition of their property, maybe they need speed and certainty. And so because of that, it's the certainty of the sale is more important than the speed of the sale. So we will always look to try and buy below market value if we can. However, sometimes we will pay the full asking price because that might already be a really good price because maybe they've already put it on the market at a low price. And also, it might be that actually the return you get on the property is so good, we don't mind paying the full price. A mistake I see investors make is they try and always get a discount, they try and pay less for the property, and actually someone else who recognizes it's already priced well might come in and actually buy that property at the full asking price, and they've got a great deal. But the investor, because they're being too tight, they kind of missed out on a great deal. So there are guidelines, there are principles, but just like investing, there are a lot of factors that come into it. So a combination of value investing and also yield.
Okay, good. Now, extending on that, so for example, if you are looking at value investing and all that, I mean, the only question that comes to me is because as traders and investors, we look for some momentum to come into the overall market rather than the individual, looking at just the individual stock or individual commodity or individual currency we're looking to trade. So in relation to that, I want to ask you, so when you buy your properties, do you look into the individual property in question, just that, and see if it's below market value? Or do you also see the overall picture in line with the overall market conditions? For example, as we are now in the COVID-19 situation. So if you just get a really good deal, which is below market value, about 30%, but do you also then look at the overall market conditions and say that, hey, you know what, but we're still in COVID-19, even if I buy below market value, maybe that might be a difficulty in getting tenants and yields, and would you then refrain a little bit?
Yeah. So obviously you need to do the research on the property, and you can, as I said, you can influence the value of that property. What you can't do is anything about the market. So obviously you want to take the market into account. And so, for example, if you were, bear in mind what's happening to the market right now, if you were looking to buy in the market right now, you definitely would be wanting to factor in expecting prices might come down. So yeah, you'll look at the property itself, you look at the market. But here's my point, and I guess it's really important to understand this, is that remember, if we're looking to hold, we're not trying to play the market. Whereas in trading, you want to come in at the right price, you might want to exit at a target price, etc. We generally don't do that. It's about as long as it makes sense and stacks up. And what I mean by that, it gives us the right kind of cash flow, gives us the right kind of return on investment at the time we buy it. Let's say we buy something for 200,000 right now, and in 12 months' time, you might be able to get an equivalent property, because it wouldn't be the same one, but an equivalent one for 180. You might say, well, surely you've lost money there. Well, we've not lost any money unless we try and sell that property. And if we're buying with the long term in mind, we don't want to sell the property. So as long as it works at 200,000 and we get the cash flow and we know we can rent it out and we get the return on investment, well, actually, buying now is actually a good thing rather than trying to wait. Because a lot of people say to me, Simon, let's just wait till the market hits the absolute bottom, then we can come in and buy. The problem with that is that once it hits the bottom and everybody thinks it's hit, either the press and the media think it's hit the bottom, and all the sellers think it's hit the bottom, then all the sellers have this hope that the value will go up, and they hope that someone else will come and pay more money for their property, and thus they hang on to it, and they're not as flexible on the price. Whereas when the price is coming down, actually that's a time we can negotiate. And I guess a fundamental point to get across to everyone in this training is that when you have a market in stocks, you have the market value. That is the market value. Whereas in property, yes, there's the market value, but it's the individual seller who can decide how much they sell that property for. And they might want to try and get more than the market value, less than the market value. And that happens to a certain extent given the condition of the property, because obviously not all, if you have a stock in Apple, that's exactly the same as someone else's stock in Apple. Whereas you can have a property on one road and another property on the same road, same size, same layout, they might have different values because of the condition of that property. Does that kind of make sense?
Yes, it definitely does. It's good that you shed some light, and you did say that, okay, so if you get some really good deal, you will go for it also because on the fact that we all don't want to be rushing for the same point when it bottoms out, because everybody else will know, and the sellers also will hold back to sell the property, and it will increase the prices. So it's really good, to consider all of that before people buy and enter into the market. So it's so I can see some similarities there. That's good. Going on to the next question, is there a best property investment that you have done to date so far? And how would you classify best? Would it be one where you've learned the best lesson, or the highest yield or capital appreciation?
Yeah. Okay, I've got one in mind, and I'll tell you a little bit about it. So I need to give you a little bit of history first. So I live in Birmingham. So I came to university, I worked here, and I've got property here now, etc. So most of my property's up here. I do have a few properties dotted around the country for various reasons, but Birmingham is my area, really. However, whenever there's a good deal, I will look at a good deal anywhere. And one of my clients passed me a lead. Someone I met at a networking meeting, they passed a lead on to me, and it didn't work for them. And this is an important thing about in property, the more people you know, the bigger your network. I believe the bigger your net worth, because you've got people you can connect with and work with and help each other. And so he passed the lead on to me, and he said, look, if you turn it into a deal, just pay me a fee, which I was happy to do. So it didn't cost me anything unless I did a deal with it. Now I'm pretty good. If there's a deal to be done, I'll get a deal because I've been doing this for 25 years, right? So this was a London property in SE20, an area called Penge, and it was a 4-bedroom masonette. And to cut a very long story short, it's a lady, she was selling. She just wanted to clear the mortgage. She was let down by another company, which she found advertising in the newspaper. They said they'd buy. They on the day of exchange, they turned around and said, no, we're not going to do it. So they really messed her around. And anyway, so I eventually spoke to her and kind of reassured her and said, well, I can't promise I'm going to buy, but, and I gave her some advice actually. And I didn't think she needed to sell the property because she had it rented out and she had some arrears, but I said, look, you can speak to the mortgage company and maybe give them the extra rent. And so I actually kind of helped her. And this is an important concept I want to get across. When we invest in property, when we teach other people to invest, we teach ethical investing. It's all about trying to find a solution that helps the seller. And I believe if you help enough people, give people what they want, they'll give you what you want. And so I could have gone in and I could have bought that property at a really big discount. But I said to her, look, actually, if I was you, I wouldn't sell it, And so I was really open. I thought of her first. She was really grateful for the advice. She went off. She got a solution, called me. She was really happy. She was worried about if this property got repossessed, it might have a knock-on effect on her own home. So all fantastic. And then one of the other things I teach my students is you always need to keep in touch with sellers because someone might not want to take your offer now, but they might in the future as they become more motivated with the time. So I kept in touch with this lady. She came back to me and said, Simon, I've decided I really want to sell again. And I said, why? And this was just 4 or 5 months later. I said, why? I said, well, and then I found the real reason. She had lived in that property with her late husband. They then moved out and they'd rented it out and he took care of everything. And suddenly she had this property where he had passed away. She had to do all the work. She wasn't actually making any money from it. She hated going back to it because it reminded her about her late husband. And because I had helped her, she called me and said, Simon, I would love you to buy. I said, well, I don't know if I can buy. Let me come and look at the property first. And I went along and I said to her, look, how much do you want? And she said she'd take the price that the previous company had offered her. And this was at a big discount. And I said, look, your property is worth more than that. And as I said to you last time, I don't think you should sell it. She said, no, look, I know you said that. And I really appreciate that. And I think because you've been so honest to me, that's why she wanted me to work with her, because I was honest and I was open with her. And so in the end, I agreed to buy the property. The value of the property I estimated was about 230,000. This was about 5-6 years ago now, okay? 230,000. And remember, this isn't my area, so I don't know the area really, but that's what I'd done my quick research. So we got a valuation, it actually came in at 225,000, okay? Now, I had agreed with this lady that I would buy the property, pretty much clear mortgage, and she was really happy. She didn't want it. And so we need to understand here, you might think that people selling their house want to get as much as they possibly can for it. And the majority of people, that is what they want. However, there's a small minority of people who just don't want the hassle. They want to get away from the pain, the mortgage liability. And she was one of these people, and actually she was happy to just walk away. So we agreed a price that she suggested of £162,000. It's worth 225. I bought it for 162. So that was a 27% discount. And that's in London. People say, oh, you can't do deals in London. Well, if you believe that, you're absolutely right. But I believe there are deals everywhere. And guess what? My students find deals everywhere. So that's not the biggest discount. The biggest discount that I've personally achieved was about a 36% discount. But wow. There's a reason why this deal was so good. It was in London, and people think you can't do deals in London. I'm not even based in London, and I was able to get this deal, okay? And that was through my network. But interestingly, at the time, all of my money was tied up in other projects. So what I did, I went to another investor who I'd worked with before, and we did a joint venture. So we put the property into her name. She put in all the money, all of the deposit. We did a little bit of work. She paid for all of that. I got the property sorted out. I got it managed, etc. We rented it out, and she put it on a mortgage for 2 years, a fixed mortgage. And the plan was for us to refinance, to take out all of her money, so we'd have a property with no money left in. But it happened to be that the London market was absolutely booming. And this property that was worth 225, we bought for 162. We spoke to a local agent, and they said 2 years after we bought it, this property's worth £350,000. And we thought, no, that can't be right. They must have made a mistake. So we spoke to another agent in the area. We said, look, this agent's valued this property at 350. What do you think? And the second agent said, no, they've made a mistake. That's wrong. And we thought, oh, yeah, it's got to be worth less than that. They said, no, it's worth more. It's worth 400,000. And We said, no, surely not. And so he said, yeah, I could get you 400,000 of this. We said, look, put it on at 410, expect a bit someone to negotiate. And then he put it on, and very quickly we got 400,000. So we bought this for 162,000. We sold it just over 2 years later for 400,000. My joint venture partner and I both made over £100,000 in profit. And it's my best deal because I put no money in at all, and I still walked out with about £110,000 of profit. So that's an example of a pretty good deal.
Oh, wow. Okay. Yeah. So that's really some really good stories you had there, right? I mean, the best discount you had was 36%. I mean, you talk
Yes.
about how, yeah, really, really great. And then the one that you bought in London. I mean, one thing I must say, everybody listening in, is that, you know, one thing that really catches my eye about how you guys train and everything, and I was recently on your property mastermind accelerator too, is that really this fact about ethical investing, because it just shows a really nice story where you shared with us how you bought this property in London and how it came back to you, because you always had the good intention of doing ethical way of investment. It's just a really good story and a good message to go out for people out there. And I really like the way that you're training your students too. So well done on that, Simon. And it
Thank you.
just goes to show again how, you know, in this story you really got a good discount too, you know, and the person was happy as well. Really great stuff.
And the interesting point is when she, you know, some investors would have gone in, seen her in a bit of distress and tried to get a great deal. I didn't do that. I went in, found out what the problem was, and I try to help her. Because I honestly don't think she should have sold the property. And that's why I gave her the advice. She didn't have to sell it first. And I thought that was the end of it. And I just kept in touch. But because she wanted to sell, she came back to me because I had selflessly helped her. Because I think it's great to put some, you know, obviously I want to do deals. I'm not doing this as a charity, and I obviously want to make money. And I say that to people when I'm buying their property, but I really do want a genuine win-win. You see, my view is if you push someone too hard, if you try and negotiate too good a deal, there's a really good chance that they will change their mind once you've spent some money with solicitors or surveys and things, and you know you'll end up losing deals, and you don't want them to be resentful. Whereas if you find really what they want and find this genuine win-win, it means that they're really happy. You get a great deal. You know, you're making money, but you're putting some good karma out there, and you know you could sleep well at night, and that's really important.
Good stuff. The last part before we go on to the next section is, so you see, for example, in a recession, and I'm sure you've gone through quite a few recessions as well in your time, banks usually stop lending or get very strict. And we usually tell our trader clients to make the money off shorting the markets and put it into property as a down payment or to get their lending. Do you have any other suggestions that they can do, like other than getting it from the markets, to get the lending when the banks get very strict?
Yeah, so banks do get strict. They get a bit nervous. They're worried about the market coming down. What we say to in the same way you say, you know, some people might sell stocks to put money in. We say to our clients, if you've got other properties, we think the market's going to come down, to refinance those properties, to take out as much money as you can. So you've got a bit of a war chest. You've got some money to buy the really good deals that come up. So that's the first thing. And then also there are some strategies, and I think we're going to touch on this later, where you don't actually have to buy the property, but you can control it. And it's called a purchase option or a purchase lease option. And these are just the same as when you get options in the stock market. You know, you've got a share, you can go and you can buy the option to buy that share at that fixed price within a certain time period. Now, it might only be a 3-week period on the stock market. I think you can get longer calls and things. However, we can do exactly the same thing. And we can go in, we can agree with an owner that we want to buy their property. We fix a price today, it's for some time in the future. And, you know, if we want to buy it, they have to sell it to us. They cannot sell it to anyone else. That's a purchase option. And then the extra thing, purchase lease option, has got that extra word lease. And that's where what we actually do is we pay a monthly fee to the owner, and then we then get to use that property. Either you can live there yourself, or you can rent it out, and hopefully what you pay the owner is less than the rent you get. So you make cash flow on an asset that you don't even own. You control it, but you don't own it. And what that means is you don't need to put in big deposits. You don't even need to be able to get mortgages. We said lenders are getting difficult. And this is a great strategy. Now, it doesn't work in every circumstance. Like anything, you need to understand when is the appropriate time to use these tools. Just like in trading, you have certain markets and certain conditions where you use certain trading tools and certain strategies. Yeah. But the point here is that we don't need to get finance because if the owner's already got finance, we kind of use their finance, or maybe they've got no mortgage at all. And we have this as a solution that gives them probably more money from the sale than they would get if they had just sold it right now. So if you own stock, you can sell a covered call, sell an option on your property. So that's a bit like getting rental income. And you could do that every single month if you want, as long as you own those stocks. Well, we can, that's what the owner's getting. In this case, we're agreeing a purchase price, and each month we give them a little bit of an option fee, if you like. So actually by the end of 3, 4, 5 years, they've got more money from that property than they would do if they actually sold it right now. So it's about understanding these different strategies and knowing how and when to use them, which most investors are completely oblivious to. And that's where you get a competitive advantage, where you have knowledge that most people don't have.
Oh, definitely. I mean, I think knowledge is power. So I think you have really two suggestions over there, which is refinancing your properties that you have. And then the other one is purchase lease options, which I really found very interesting when I was doing the seminar with you guys. Now, going on to the next section on risk management. So in trading, the first thing first we always look at is risk, even before the profits. We always say that you should always know how much you're going to afford to lose rather than thinking about how much you're going to make. That's how a professional thinks.
Yes.
And also, one thing we always say is that the upside always looks after itself. You just got to look after the downside. So likewise, on that, we use very strict risk management rules, and we know our drawdowns of any particular strategy before we start. So we mitigate our risk. So likewise, how about you guys as property investors? How do you guys mitigate your risk? Is it simply to see if the yield can cover the mortgage payments? Or
it's critical to do that. Yes. So in my book, Property Magic, which is an Amazon bestseller, and has been for the last 12 years. It's not like a flash in the pan. We sold over 100,000 copies. So I recommend if people should go and check out Property Magic on Amazon, or make sure you get the 6th edition, which is the latest one. I have in there 5 golden rules. And I created these in 2007 when I first wrote the book, and they're still very valid today. And the idea was I saw a lot of people making investment decisions that weren't good. And, you can lose money in property like you can in trading as well if you don't know what you're doing. But if you follow these 5 golden rules, you can mitigate a lot of that risk. So I'll just give you 3 of them for the moment. One of them is rule number 2 is we only buy in an area with strong rental demand. Remember, if you're buying a rental property, the whole point is you rent it to someone else, and the rental income that they give you covers all the costs, more than covers the costs. So you've got to make sure you can rent it out. Rule number 2. Rule number 3 is, linked to rule number 2, you must make cash flow. And what that means is after all of the expenses, you take the rent, less also, there must be profit left over for you. If there's not monthly profit, that is not an investment. You should not buy it. That's a speculation. Sometimes people will buy properties with the hope they're going to go up in value. And yes, they might well go up in value, but there's no guarantee that's going to happen. So you must be getting a return from when you buy the property. And then rule number 4 is we buy for the long term. And I've already mentioned this in that, yes, the market goes up and down. It's difficult to predict what that is. So rather than trying to judge it, just buy and hold for the long term. And we don't really care what happens short term, because we believe long term, the value will always go up because of the supply and demand in this country.
Ah, interesting. Okay. So the 3 things: strong rental demand, cash flow, and buy for long term. Just a quick question on that, Simon, is that what happens in a situation like in COVID or in recession that, people cannot go to work, they don't get their salary, they can't pay the rent, and it's a ripple effect. What are the backup measures that you guys got for that to mitigate your risk, and so that, you net profit, cash flow?
Yes. So two things really. And regardless of COVID-19, there's always the possibility that your tenant runs into financial difficulty, they lose their job, they have a relationship breakup, whatever it might be. something causes them to go off the rails and suddenly they can't afford to pay your rent. Yeah. So let's be realistic. That happens sometimes. Okay. Even forget COVID-19, that happens in everyday life. And so there are a couple of things really. First of all, when tenants don't pay the rental income, there's a process to get them out of the property. It takes several months, but you could evict them, and then actually you can actually get an award against them. So you've got up to 6 years to get a payment of rent that they owe you. So what we'd often do is we would get a judgment against them, let them settle down for a few years, then go and track them down, which is fairly easy to do. And we get a high court sheriff to go and put a claim on them. And it's great, especially if a few years down the line, they've bought a property and they've settled down and this is someone who works for the court basically, so they can't just ignore them. So that's the way you can get your money back. That doesn't help the short-term cash flow though, obviously. So golden rule number 5 in the 5 golden rules is you always need to have a cash buffer. This is some money put aside to cover unexpected expenses, things that may not be covered by insurance, so that if these kind of things happen, you can obviously make sure you can cover the costs for the period you need to cover them. Okay. And thinking about COVID-19, luckily, touch wood, when the government announced in March they were going to have these rent holidays for people who are struggling to pay, we had one tenant contact my letting agent straight away and say, oh, I don't think I'm going to be able to pay the rent. And in a very sympathetic way, we said, okay, no problem. So just give us some proof you're in a financial difficulty and let's see if we can work something out. Interestingly, they provided no proof and they paid the full rent every single month. So I think there was a lot of knee-jerk reaction from tenants and also from landlords kind of panicking. I have had one tenant who is in an HMO, a house of multiple occupation. They are on a furlough, so they're only getting 80% of their salary. And they spoke to my letting agent for that particular property and said, look, I can't afford to pay the full rent. I'm only being paid 80%. Is there anything we can do? And I don't want to move out of the property. I don't want to have to go back home, which was the choice. So rather than lose that tenant and maybe struggle to put someone in, we said, look, you're getting paid 80% of your salary. We're happy to get 80% of the rental income to keep that person in the property rather than losing that person. And then the deal is that when they get back into work, they can actually make that money up again. Okay. So I think have a cash buffer, work with the tenants. All my other tenants are paid in full. Now, if I'm honest, I think the crunch time is going to come in October. There are millions and millions of people who are on furlough, which is a great scheme to keep people technically employed, even though they're furloughed, rather than making all these people redundant. Because in retail, in hospitality, in events, there are going to be lots and lots of people who are made redundant, unfortunately, in October. Overnight, there might be millions of people made redundant, or over a week period or so. So obviously, those people can then go and claim benefits. And at least then the government is covering the rent for you. Now, it might not be the full rent, but at least it's some money they're going to get to make sure you're not having to cover all of the cost yourself. So, it's not an ideal scenario, but it's not a doomsday scenario either.
Okay, just a quick question on the cash buffer thing that you say. What would you say the time period of cash buffer they should have? Is it 3 months, 6 months, 1 year?
It really depends. I mean, and also, obviously, the more properties you have, the more cash buffer you should have. But you should never have a situation. I had a lady ask me that question actually, and I said back to her, I said, "Well, what would you be comfortable with?" And she said, "Well, I'd like to have 6 months of mortgage payments in a bank for my property." And I said, well, that's quite a long time, because even if you had a bad tenant, it probably wouldn't take that long to kick them out. But okay, let's say 6 months. And she said, I've got 10 properties, so I'm doing it for all my properties. And I kind of looked at her and said, look, if you think you can have 10 empty properties at the same time, don't do property. Okay, if you're really that worried about it, there's something else to do. So it is really a kind of it's down to the individual to assess what level of buffer they're comfortable with. The whole point is you want to be able to sleep at night knowing if something goes wrong, you've got some money put aside to cover it. Now, it could be money in a bank account. It could be a credit card. Not suggesting you put things on credit card, but let's say your tenants moved out or they weren't paying and you couldn't pay the mortgage. you could call up the mortgage company, although normally you pay on a direct debit. If you said, look, I've got no money in my account, but I'd like to pay by credit card, believe me, they would accept the credit card payment. Okay. Now that should only be a short-term measure. You'd want to obviously pay that credit card back as soon as you can, but it's about having that flexibility and ability so that you can make payments to make sure the mortgage is paid, which is the most important thing for you as a property investor.
Simon, personally yourself, I mean, what do you go for? Do you go for 3 months, 6 months? What is it?
Not even that. I've got credit cards with good facilities on. I've got some cash savings in the bank. So I don't really have a guide. And I said, you know, even if you said, right, it's 3 months or 6 months, well, that's not going to be for every property you have. So my gut feeling is I'd want several £1,000s for each property. So if you had 10 properties, you might want £25,000, £30,000 that you can get access to. It doesn't necessarily have to be cash in the bank, but money you can access to cover out any unexpected expenses. You would be very unlucky to have all of your properties empty at the same time, or you've done something wrong if that's the case.
Got you. Just a very quick question on this section before we carry on to the next one is, what kind of a leverage would you recommend to be safe in most market conditions? Is it the typical 25, 75, 20, 80?
Yeah, so 25% deposit is what most banks want at the moment, a 75% mortgage. In the good old days in the mid-2000s, I had some buy-to-let mortgages at 90%. Because the market was booming and everybody thought the market would keep going up. And that was good because, you know what, it meant I had to put a smaller amount of money in. I could get more properties. I think that did cause a problem. Some people over-leveraged, and when the market churned, that was an issue. But I think the banks have actually made the decision for us because they've set the level at 75%. So they're thinking, well, you know, they don't want properties to go to negative equity. So I think they're thinking, well, actually, 75% is enough for a buffer. So I'm pretty comfortable with 75%. If you're later on in your journey, you know, I think you might take out more borrowing at first when you're younger to get more assets. But I know a lot of landlords who, as they get older, they start to pay down some of those mortgages and reduce the amount of borrowing.
Yeah, that's good, Simon, that you shared that. Last question in this section before we move on is, you see, in trading, we have, I mean, one of our biggest risk managements is to know our drawdown, which is what you guys also have worked out in terms of your leverage and all that. Another thing that we also do is that we trail our stop loss. We've got a thing called a stop loss, initial stop loss, trailing stop loss. And sometimes if we want to get risk free, and that's when we know when to move our stop loss to break even. So we cannot lose anymore. We are riding on market profits at the moment. You see, based on that, what I want to ask you is, there's two types of mortgages usually. I mean, one is interest only mortgage, and the other one is a capital repayment mortgage, where it's interest plus capital repayment.
Yes.
Now, of course, with the capital plus interest repayment, there can come a time, of course, you can come similar to trading where you have absolutely broken even. There's no risk anymore. Everything that's coming in is totally positive cash flow. Everything will have its pros and cons. So what would you say between these two types of mortgages, and what would your preference be in terms of also mitigating risk as well? Is it a capital plus interest repayment, which is first, usually in the short term, which is a bit more tighter on your cash flow, but in the long term, it increases your cash flow? Or is it only interest only mortgage?
So again, it kind of depends where you are in your investing cycle. Right. Remember, when a lot of people first get into property investing, they want to get cash flow. And so for that reason, I think most investors will go for interest only mortgages. Remember, an investment property is different from your own home. Your own home, at some point in the future, you need to have paid off the mortgage, because when you get to 65, 70, the lender's going to say, well, you know, you should be retired, but then how on earth are you going to afford to pay a mortgage? So that's why most people get mortgages to that kind of age on their own home. But what you must remember is when you're 70, if you've got an investment property, you can still get a mortgage on that for another 20 years. Because you're not the person who's paying the mortgage. It's the tenants who are paying the mortgage for you. So what you're going to do is separate your thinking from a homeowner is different from an investor. So investors, we don't really need to pay back the capital, because if you hold a property for, say, 20 years, even if you buy it at the wrong time, there's a good chance that that will have gone up in value, maybe doubled, or maybe even doubled and doubled again in that 20-year period, depending when you buy it, okay? So your exit could be to either refinance that property to pay off the first mortgage, or it might be to sell the property, clear the first mortgage. You'd have some tax to pay, capital gains tax, just like when you sell shares. But obviously, there'd be a huge profit there. And then that profit could be used to pay down some of the other properties if you want, ones you want to keep. So it kind of depends on your exit strategy. But generally, most people going in, it's about an interest-only mortgage, get it for a nice long 20, 25 years. Now, you're probably going to change it out for another lender anyway. But the whole point is that it gives you the ability to really, how can I put this? To really maximize the opportunity while you're trying to build your portfolio. So you've got the best cash flow coming in, and also you're in a situation where you can buy as many properties as you can, because the lender will also look at the affordability. And if you have an interest only mortgage, the monthly payments are less than a repayment mortgage. So therefore, a repayment mortgage not only affects your cash flow, it might affect the amount you can borrow, because they want to make sure the rent's enough to cover all the costs. So therefore, if you can't get as much of a mortgage, you need to put more deposit in, so it could slow down the speed at which you're buying properties, because your money is spread amongst a smaller number of properties. Does that kind of make sense?
Yeah, I guess definitely. And I think you nicely said it. It depends on your exit strategy. It depends on where the investor is in terms of their cash flow. Because I know in the short term, it is very difficult for most people. But in the long term, I'm just thinking in terms of elevating risk altogether, such that certain situations can never affect you. But I guess, like you nicely said, I mean, it depends on the exit strategy and depends what the investor is in their cash flow, I believe, right?
Yes, absolutely. Yes.
Okay, good. So we move on to the next section on exits. So in trading, we have predetermined targets sometimes based on open equity, or we have adaptable targets that we change according to market conditions, according to price velocity or open equity data. So for property investors, do you guys have predefined exit points, or do you buy and hold it forever? I remember you telling in the previous question that your style is usually to hold it forever, but do you have certain times when you might change that, or you have certain scenarios where...
Yeah, so it's a great question. In theory, we buy and hold forever. However, there might be a couple of things that happen that trigger a sale. So, for example, let's say I've in the last couple of years, I've sold a few properties. I had some that I had short 10-year mortgages on that I bought in 2007, 2008. And for whatever reason at the time, 10-year mortgages were very popular. I think they were very good interest rates. And obviously 2017, 18, those mortgages ran out. And on some of them, because I bought in 2007 at the top of the market, there might not have been enough equity there to just refinance at a 75% mortgage. So actually maybe selling the property was a better solution. And also sometimes you sell, for example, that one in London I gave you, we could have refinanced that, hold on to it, but we thought there's so much cash in there, we'd have to leave a lot of cash in, and actually we could take that cash out, pay the tax, and put it into much better investments elsewhere. So in a similar way, you might have a share, you think, you know what, this share has pretty much run its course. It might go up higher, but I think I had most of the growth. I might be able to sell them, take the money out, and I can put them in a share that's got more potential. So we might do a similar thing in property in that way. Or the other reason I might sell a property is if it breaks the golden rules. So golden rule number 2 was, remember, I must be able to rent it out easily. What if maybe there's an oversupply of property in the area? They've built lots of new property. It's hard to rent out. I can't guarantee I'm going to get a tenant, which means I won't get my cash flow, which means actually maybe selling it might be better than holding something I can't actually rent out. Does that make sense?
Oh, yes, that's right. Yeah, because factors might change and you got to look at that point of time on what the conditions are, basically.
Indeed, yes.
Okay, great. That's interesting, isn't it? I think that leads on to our second question, actually, because you were saying that in 2008, you bought that property, which you bought at the top of the market. So in that sense, you wanted your money to work harder. So you sold it off so that you can invest it in better properties and buy some more cheaper ones. So then we are bordering onto the factor of timing.
Yes.
So you see, especially in global meltdowns where the recession lasts for 2 years, I mean, of course, like you have done personally yourself, be wise to liquidate some properties and buy others for cheaper prices. And this is the same thing that traders and investors also do in the stock market. But of course, certain people will always advise you against timing. But how do you counteract timing, and how have you got timing factored to get out of your investments? Do you look at some charts? Do you look at some
Well,
indexes?
so the only timing limitation really is if you get a mortgage and you're running out of time on that mortgage and you can't sell. So I'll be perfectly honest here. One of the properties I bought back in 2007 was a new build property in Nottingham, actually in Long Eaton, which is a suburb of Nottingham. At the time, it seemed like a great deal because it was a no money down mortgage. I got an 85% mortgage. I had a 15% gift from the developer. So I had to put no money into that property. But the market, I think when I bought it, it was overpriced. Even though I got a discount, it was still overpriced. And that's because the whole market was overpriced and surveyors were saying, oh, it's worth 125. And, I effectively didn't pay that, but that's what it was worth, apparently. And it comes to the end of the 10-year mortgage on this particular property. And, the property right now is only worth £80,000. So it was in negative equity. And I to keep that property, I would have had to put another 25% deposit in. And actually, it wasn't such a good property anyway. If I had my time again, knowing what I know now, I wouldn't buy that property. And so I was forced to sell that one at a loss, at a capital loss. Now, I also sold another one in the same year that I had big capital gain. I just offset the two. But I was kind of almost forced to sell that one. Otherwise, I was going to keep it. I really didn't want it. So I didn't want to throw good money after bad and put it in and keep a property, which ultimately I didn't want. So I was caught out by the timing there. And that sometimes happens. But if you have a nice long 20, 25-year mortgage, you're going to minimize the chance of that happening.
Right. So you're saying using mortgage to get out of the timing. That's what you do. Is that right?
Yes.
Mortgage length period. Do you look at any indexes or anything to get?
Think about it. If you've got a property and think, I don't want to sell this right now because it could be a loss, well, you could remortgage it and you're delaying that decision and hopefully allowing for future capital growth.
Right. Okay. Do you look at anything like similar to stock market, we got something like price to earning ratios? Do you look at anything to price to rental ratios to help with your timing or the wealth cycle?
We'd call that return on investment. So we look at how much money do we have to put in compared to how much profit are we going to get out every single month. The ROI, the return on investment, cash on cash return. And so those are the calculations that we will do to say, yes, this is a good return. I'm happy for this. And that's where the market's booming or crashing. If you're happy at the day you buy, fantastic.
Right. Okay. Interesting. Right. Okay. Good. So we covered that now. So that's great. I mean, we're just going on to the end of this session today. Just a little bit on psychology, actually, Simon. As with trading and other investments, psychology is very critical to keep your mind focused and be on the present moment.
Yes.
Not to be moved by your emotions to buy something just based on pleasure. And actually, especially in trading, I don't know about how in property. I mean, that happens quite a bit. Because it's so fast. It's much more faster than in property, and it's much more liquid as well. I mean, for yourself, to find the right investments, to continuously keep going and to keep reevaluating whether it's a good investment or not, do you have any practices that you do to keep a healthy mindset that is focused and ever creative?
Yeah, mindset's really, but I have my bad days just like anyone else. I kind of think, oh my God, what's going on? And I think it's being aware of your mindset and trying to change your state is a good idea. So imagine if you're trading and you're getting stressed about trading, get up, go for a walk. My partner's very good at that because she'll say, come on, get up, go for it, do something, because she doesn't want me in it if I'm not in a good state and I don't want her not in a good state. So getting people around you also understand it, that can be quite a good thing to help you and recognize that, I think whether it's in business, whether it's in property, whether it's in stocks, mindset is the most important thing. You can know all the strategies in the world, but if you don't have the right mindset, you might not make the right decisions.
Very true. I mean, like yourself, do you do any meditation practices or breathing?
I do. I meditate I wouldn't say every morning, but I try and do every morning. It's only a short meditation. I've got out of the habit. I used to do yoga every day. I've got out of the habit. I do that every day. I'm trying to get back to that. I think that's quite good and relaxing. And also, I think taking a bit of time, I love writing notes and things, and taking some time just to think and plan things out is good. And you know, when you're busy, it's difficult to do that sometimes. And last few days in particular, I've been ridiculously busy because we're just doing a big launch for some new training at the moment. So I've been ridiculously busy, but that time out to think is very important.
Great stuff. Okay, so I think we can now come into the Q&A section, which is open to the audience. If you got any questions at all, just type in your questions. Now, as you're doing that, Simon, is there anything that you want to share with us further, like on your screens or something like that?
No, I don't have anything to share really. The one thing I would say is that obviously, if people want to learn a bit more about property, I know later on at the property, you're going to give people a link where they can go and pick up some free training webinars about property, the best strategies, and learn more about that, or go get my book, Property Magic. But nothing else to share really. I'm just happy to answer any questions that come up.
Okay, great stuff. So just based on that, so where can people go to find out more about you? I think you gave me a link, and that's for your next webinar. Is that right?
Yes. So we're doing a webinar. We're just in a launch at the moment about a really good show, which is purchase lease options that we mentioned earlier.
I think this is the one I've got on the screen. Is this right?
Yes, it is indeed. Yes, that's it. Yeah. So if you, in the chat box, you want to share that link, people can go there. It's a webinar actually next week, so plenty of time for you to come and register for that. And I'll really be talking about what's happening in the market right now, whether you're new or experienced, what I believe is the best strategy you really should be using, and it's purchase lease options. I'll explain how you can use that, when it's appropriate, when it's not appropriate, and it's a really, really powerful strategy. So I'd really recommend people go and register for that. Just maybe the link's in the chat box, maybe click on that link now to open up that window, and once this training's finished, you can obviously go and click on that.
Okay, good. Good stuff.
For people who are watching this recording afterwards, it's a bit.ly link, so it's bit.ly, then /PLO MTM. And
yeah,
PLO,
I just put that onto the chat box as well. So that's
it's in capitals, guys. So the end of it's capital. Bit.ly links are case sensitive, and basically it's PLO, purchase lease option, master the markets, and that's the link for you.
Okay, brilliant stuff. All right, so I will see if there are any questions coming up, so they can. As of now, not yet. We don't have anything else. If there's anything else you want to share with us, we just got about 2 more minutes left. That would be...
what I would say, guys, I think, you know, I'm a great believer in diversifying your investments. So within property, I have different types of strategy, different areas I'm investing in, but also I invest in stocks and shares. I'm actually waiting at the moment. I think the market, I do very simple investing, not quite the clever stuff you guys teach. I think some great opportunities coming up in the next year or so there. I also invest in businesses as well. I think diversifying your assets is a really smart thing to do. And if anyone's interested in property, you know, a great thing to do would go and get my book. It's Property Magic. You can get it on Amazon as a physical book, as a Kindle, or even on Audible as an audio book. And also I have a podcast. If you like listening to podcasts, have a completely free podcast you can get on iTunes or Google Play or Spotify called the Property Magic Podcast. You might want to write that down, Property Magic Podcast. And every Tuesday I come up with a new edition, 15 to 20 minutes, new episode. There's no adverts, no one else, just me talking about great property content. And so there's some free resources for you to check out. I also have a YouTube channel, so type in Simon Zutshi, it's Z-U-T-S-H-I into YouTube. You can subscribe to those. And if you want to connect with me, just look me up on LinkedIn.
Okay, good. I think just one quick question, Simon. I think it's that, I think we had this in the last interview as well, is that if there's any location that you would recommend people to start looking into for really good yields and all that, would there be anything that comes to your mind that you recommend?
Yeah, well, I don't recommend locations for the simple reason that even if there was a great location right now, someone could potentially watch a recording of this 6 months later, and that might not be the case anymore.
True.
What I would suggest actually is a big mistake people make is they think, oh, it won't work where I live. I need to go outside my area. And actually, most strategies work in most areas. There are motivated sellers everywhere. And so I'd say a great place to start is always where you live or where you work, because you're just going to have a better understanding of what that market's like. So that's a great place to start. And then if exactly where you live doesn't work, maybe 45 minutes drive from there, there'll be somewhere where it might stack up better, give you a better return on investment. Or ultimately, if you want to invest outside of your area, with the internet these days, that's possible. And we have our Property Investors Network. The website for that is PIN-meeting, P-I-N, meeting.co.uk, pinmeeting.co.uk. It's a list of the 50 locations we've got PIN meetings, and at the moment they're virtual. So what that means is if you say, right, I want to go invest in Sheffield or Hull or whatever, you could go to the local PIN meeting, attend the virtual meeting, connect with people in that area who might be able to find deals for you, might be able to manage deals, might be able to do the refurbs for you. You can connect and build your local network virtually without even having to travel. I mean, obviously, you will need to go there at some point if you're buying property, but you can certainly build your network, get your contacts, and really educate yourself by tapping into that local network.
Great. I think the final question then, Simon, is that in today's market conditions, what would your final advice be? Would it be to just sit back a little bit and just watch how things plan out? Or if they still find a really great deal, to go out and do it? What would it be?
Absolutely. So as long as you know what you're doing, and that is the caveat, you need to know what you're doing. There are some fantastic opportunities right now. If you sit back and wait for the perfect time to invest, there's a risk that's never going to happen. So I would suggest use this time to educate yourself. There's so much free information out there. There's, when I started investing, there really was no internet that the general public were using. There were certainly no webinars. There were no magazines. There were no trade shows. There was nothing. And so I was doing it very much the hard way, trying to learn it myself through trial and terror. There is no excuse for people these days not knowing what to do. There's so much information out there. In fact, there's a bit of a problem. There's almost too much information, and people get overwhelmed. And there's, well, how do you work out what's the right information and what's not the right information? And the secret there is actually that's why people pay to come and do training. Because when you do training, often some of the information is what you can get for free. I mean, I put a lot of really great free information out, but when you come on a course, it's organized for you. It's in an easy to understand format. So rather than trying to have to work it out yourself, we kind of spoon feed people the information so that they get it in a practical way that they can actually then go and implement it. So I believe that the very best investment you can make, better than trading, better than property, is always investing in yourself. When you get specialist knowledge, you have a real competitive advantage.
I absolutely agree with you, Simon. I mean, absolute knowledge is always critical, and knowledge is important for preparation before you take your action. And always with the right knowledge that is organized and structured for you, like you say, in courses and workshops, is so critical. And it shortcuts your journey by so many years, rather than making all the mistakes that we all have done in our own.
Absolutely. Whenever I want to learn something, I will always try and go and find whoever is really good at that, who happens to be teaching other people how to do it. And I will spend money with them because I want to save myself time. Time's my most valuable asset.
Exactly.
But I don't want to spend hours and hours watching things on YouTube and listening to webinars, trying to get it all for free, where I can find out the information I really need to know and actually get out and start getting results. And when you apply that information, you'll make back the money you've invested many times over much quicker than if you're trying to do it on your own.
Yeah, absolutely. Thanks for sending that message on. Is what we absolutely always tell, and I think that what all the influencers in this space also keep saying the same thing, which is, one is that shift in mindset where you just got to think in terms of time is your most important commodity rather than money. And if you can hang around the professionals, you shortcut your journey, you get there much faster. And definitely Absolutely. One thing, thanks for sharing, is that your next webinar, and of course that's one first step that you guys can do to shortcut your journey by hanging around with professionals like Simon, and I definitely highly recommend it, being on his course as well. And that especially, I would say, the biggest differentiating factor about Simon than anybody else is the ethics that he involves into it. So the investment just doesn't come as just purely just an intellectual rationalization game on numbers where you're outbeating the other person, but you also do it with a heart as well. So I think that is really great. The next one is this purchase lease options. The webinar link has been posted to you guys. I'll send it on recording and to the entire database. Thank you so much today, Simon, for coming on board. It's such a great pleasure. Thank you. And bye, everyone.
Thank you for asking me. Guys, good luck. Invest in knowledge, invest in skill. Thank you very much.
Thank you.